All right, today we're going to do something a little different. We're going to unbox a specific type of financial safety net, accidental death insurance. What is it really? We're going to peel back the layers of one particular policy to see exactly what it promises, what it actually covers, and maybe, most importantly, what it leaves out. I want you to just imagine this scenario for a second. An unexpected accident happens, and it leads to the worst possible outcome. Now, beyond that huge emotional toll, it can create an instant financial crisis for a family. That right there, that's the exact problem a policy like this is built to solve.
So here's our game plan. First, we'll cover the basic idea. Then we'll unbox the main benefits and the rules for getting covered. We are going to pay very close attention to the exclusions. Trust me, what's not covered is key. Then we'll look at a pretty unique optional feature before we tie it all together to help you figure out if this is the right fit.
Okay, Section 1, an accidental safety net. So what's the fundamental job of this product? Let's define its actual role in a financial plan. At its core, the concept is incredibly simple. Accidental death insurance, or AD insurance, pays out a single lump sum cash benefit to your beneficiaries. The one big condition? The death has to be a direct result of a covered accident. That's it. Now, this slide is where it gets really clear. It perfectly positions the product. Over on the left, you see what it is. Super simple, accidents-only coverage. Then in the middle, you see the main reason it sells. It's guaranteed issue. That means no poking, no prodding, no health questions, no medical exams. It's easy to get. But that column on the right is absolutely crucial. This is not life insurance. It will not pay a dime for death due to sickness, disease, or natural causes.
All right, on to Section 2, where we unbox the core benefits. This is where it gets interesting, because the payout isn't always just one flat amount. Let's see how the benefit can actually multiply depending on how the accident happens.
This chart shows a really cool feature, benefit multipliers. Let's walk through it. Say you have a base coverage of $250,000. If a death happens in a covered car accident or as a pedestrian, the policy pays out an extra 50%, bringing the total to $375,000. Now, if it happens while you're a paying passenger on, say, a bus, a train, or a plane, what they call a common carrier, it pays an extra 100%, doubling the payout to $500,000. Okay, let's move on to Section 3, getting covered. Now we know what it pays, but what are the rules of the game? Who can even get this, and what are the basic terms? The good news is the eligibility is pretty broad. You can apply anytime between the ages of 18 and 70. You can pick a coverage amount from $50,000 all the way up to $500,000. And once you've got it, the policy is guaranteed renewable right up until you turn 80, as long as you keep paying the premiums. And yeah, it covers you 24/7. Doesn't matter if the accident happens at work or on your day off. And you're not limited to just covering yourself. You can extend this to your family. As you can see here, a spouse can get 100% of whatever your benefit amount is, and your dependent children can be covered for 20% of your benefit, which provides a smaller but still pretty significant layer of protection.
Now listen up, because this is a really important little detail you need to flag. If you want to cover your spouse, you have to do it right when you first apply. You can't add them on later. If they decide they want coverage down the road, they're going to have to go and apply for a totally separate policy all on their own.
All right, let's dive into Section 4. And honestly, this might be the most important part of understanding any insurance policy, the exclusions. Knowing what isn't covered is just as critical as knowing what is. This comes straight from the policy's compliance guide, and it could not be any clearer. This policy is for accidents, full stop. Sickness is not covered. This is the fundamental line in the sand you just have to understand. So this slide lays out the major no-goes. The policy will not pay for a death that results from disease, from suicide, or from acts of war while in the military. It also shuts the door on deaths that happen while you're committing a felony, while you're intoxicated, or during certain high-risk hobbies like, say, flying a plane yourself or drag racing. Okay, Section 5 brings us to a really interesting optional feature. It's designed to tackle that one big what-if question a lot of us have when we pay for insurance year after year. You know the question, right? I'm paying all this money, but what if I never actually use it? Well, this policy has an optional add-on that speaks directly to that. They call it a rider, which is basically just an extra feature you can bolt onto your base policy. So this add-on is called the Return of Premium Rider.
For an extra cost, it promises to give you back a portion of the premiums you've paid if your policy ends for any reason other than an accidental death claim. So if you outlive the policy or you just cancel it, you can get a percentage of your money back.
And here's how that works. For the first 3 years, you get zero back. But after that, the percentage of premiums you can get back starts to climb year after year until it eventually hits 100% of everything you paid in once you cross that 30-year mark.
Of course, like with everything, there are rules. You can only add this rider if you apply between the ages of 18 and 50. And it's also really important to note that it isn't available everywhere. You can see the list of states where you just can't get it right here.
And finally, Section 6. Is this coverage for you? We've unboxed the benefits, we've gone through the rules, and we've stared down those crucial limitations. So now let's put it all together and answer the biggest question of all.
So let's do a final tally. What this is, a simple, pretty affordable add-on for a very specific risk. What it isn't, a replacement for comprehensive life insurance. No way. The key feature to remember, those benefit multipliers that can really pump up the payout. And the key consideration, you have to be okay with those strict exclusions for sickness and other things. And that optional perk, the return of premium rider, which is a neat little safety net for your premiums if you can get.
So the final question, that's all on you. This is a highly specialized tool, not some catch-all solution. It's designed to plug a very specific gap. The real challenge is to look at your own financial situation and decide, is this the missing piece of your safety net? Or is it just covering a risk that you've already taken care of somewhere else?